All right, y'all, I've got an interesting one for you today. If you're new to my channel, my name is Rebecca. I am here on YouTube documenting my journey to financial independence. On Mondays, I like to share a blog post from my favorite financial independence retire early blogger, Mr. Money Mustache. As always, I link to the blog post that I am reading from below if you would like to go and check out his website and read some more of his posts. I really enjoy his sense of humor and his perspective on things when it comes to financial independence. If you're at all familiar with the FIRE movement, I would say that the majority of people in the FIRE movement actually prefer to be index investors. They either invest in index funds or ETFs. They typically prefer the broad-based, low-cost index funds through Vanguard. That seems to be the popular method of investing for the majority of people, and indeed, I tend to lean that way also, but I'm trying to broaden my investing knowledge and dally a little bit into dividend investing. And today's blog post from Mr. Money Mustache is from December 22nd, 2011. He's been blogging for a long time, but this one is titled, Guest Posting from Dividend Mantra. What is dividend growth investing? And I know also that there are a few of you that follow my channel who are big into dividend investing. So I definitely wanted to share this blog post with y'all because I know that dividend investing interests y'all, as it does me as well. So we'll jump right into this one. Hello everyone, Mr. Money Mustache here. Over the next few weeks, we shall dive into the exciting field of dividends, the magical stream of free money that companies pay you just for owning their stocks. In simpler times, i.e. those before 1960, this stream of dividends was the primary reason anyone would even consider owning something as risky as stocks. In the most recent half-century, however, stock investing has become more popular and a mania has sprung up around it. This has driven up share prices when measured against the underlying earnings of the companies, and it has spawned a whole legion of market timing and momentum-based trading that attempts to predict the immediate future of stock prices based on recent fluctuations in those same prices. The more I read about investing, the more I am convinced that buying boring but successful old companies with high earnings, high dividends, and low share prices, exactly what Warren Buffett has done for decades to become the richest investor in the world, is the best way to be a successful investor. Buying index funds indirectly accomplishes this, since there are plenty of boring old companies mixed into the S&P 500 index, but for a purer and more advanced form of seeking out higher income, dividend-specific investment is a field to look into. Academic studies of stock market performance strongly suggest that if there is any way to beat the returns of the overall stock market on a risk-adjusted basis, it is by buying stocks with high dividend yields and a low price-to-earnings ratio, also known as value investing. And from an early retirement perspective, retiring based on a diversified stream of dividends rather than a fluctuating set of share prices leads to a much less volatile financial life. When the stock market dropped by over 50% around 2008, retirees living off of their dividends barely noticed, since the underlying companies barely cut their dividend payouts during that time. As the final icing on the cake, dividend earnings typically increase along with inflation over time, making them a much more viable source of lifetime income than a mattress stuffed with cash or a savings account earning 1% interest. We'll open the series with this guest posting from a guy who goes by the name Dividend Mantra. You can learn more about his philosophy by reviewing all his archives at dividendmantra.com. What is dividend growth investing? Triple M was kind enough to invite me to do a guest post introducing some of his loyal readers to dividend growth investing and some of the basic fundamentals behind this investment strategy. I'm not going to get too crazy with numbers and ratios, but instead I'm going to focus on the qualitative nature of this investment strategy. A little about me. First, a little background on yours truly. I was born in 1982 and got serious about saving, living frugally, and investing in mid-2010. It was when I found out that my net worth was negative and I'd likely be working until I was dead that I decided to change my ways. I read a fantastic book titled Your Money or Your Life, and this definitely transformed my relationship with money and the way I looked at work, money, consumption, and time. I decided that the limited time that I'm given here on Earth should be used how I see fit and not in exchange for bigger and better objects in an endless pursuit of the enigmatic Mr. and Mrs. Joneses. I now save well over 50% of my net income and invest that excess capital into dividend growth stocks, although I highly recommend diversifying your capital into multiple investments. I'm going to just concentrate on stocks today, as that is primarily where my net worth lies currently. Simpler than you think. Dividend growth investing is a strategy of investing whereby an individual engages in long-term investments with quality businesses that are expected to grow revenues, earnings, and dividends over a long period of time by selling, manufacturing, and distributing products that people want or need every single day. These investments are made by purchasing common stocks of these businesses that pay quarterly, semi-annually, or annually dividends to shareholders. These companies typically have long-term successful track record already behind them. Examples of these businesses include Coca-Cola, Walmart, Colgate-Palmolive, and ConocoPhillips. These businesses are all generally household brand names that produce quality products that people want and need. I try to invest in companies that I use every day. Although I'm significantly frugal, I still drink Coke. I brush my teeth with brand name toothpaste because I trust it, and I shop at major retailers like Walmart because they're convenient, cheap, and usually centrally located along a bus line. Speaking of the bus, it runs on gas, which is refined from oil. Although I don't own a car, I still have an indirect need for oil, which is where investments in quality, large international oil producers like ConocoPhillips come into view. Concentrate on value, quality, and an economic moat. Although money managers and brokers want you to believe that investing in the stock market is incredibly difficult, it's really not. Notice I use the word investing in the preceding sentence. Long-term investing in the stock market is an incredibly efficient way to build wealth for a patient and focused individual. People who trade in and out, hopping from one investment to another, are simply transferring their wealth from their wallet to the brokers that facilitate trades. That is not investing, that is betting. Concentrate on value. Any object or service in the world has a price and a value behind it. Price is what you pay, but value is what you receive. It's no different with stocks. Paying a premium for a quality business will always be better than getting a steal on a stock with a lousy underlying business. I typically try to invest in quality companies that have a price to earnings ratio of less than 20 and preferably less than 15. With a price to earnings ratio of 20, that means I'm paying $20 for every $1 of earnings. A lower valuation and consequently a lower PE ratio means that investors are expecting lower growth going forward. It's important to realize the market isn't always correct, and it's key to capitalize on businesses that are high quality and trading for a cheap price. At that point, you're getting great value for a cheap price. Concentrate on quality. Recognizing quality is key for a successful investor. Quality is usually backed by a consistent product with a brand name that people are usually willing to pay a premium for. Again, going back to my Coca-Cola example, I'm willing, even as frugal as I am, to pay a premium for Coca-Cola over store brand cola because to me it tastes better. I'm certainly not alone because Coca-Cola sold over $35 billion worth of products last year. If you want to commit money to an investment, it's probably a good idea to try the product if it's applicable. Want to invest in McDonald's? It's easy to check out a couple different locations and see if they're busy, serving a consistent product, clean, and offering efficient quality service. This isn't always applicable to an investment, but if it's available to you, it's a good idea to see the company behind the stock. The key is doing your research and discerning quality. Concentrate on companies with an economic moat. An economic moat is a competitive advantage that a business has that prevents other businesses from infringing on its market share. Companies that have pricing power, economies of scale, brand names, large distribution networks, and barriers to entry have economic moats. Think of a company like a castle. The larger the moat around that company, the better defense it has against outside forces, competing companies. Coca-Cola has a large economic moat because of its global footprint, large brand name exposure, quality of product, and economies of scale through volume and distribution. These aspects of Coke's business are extremely attractive, and that's why Coca-Cola usually sells for a premium over its competitors. They have a majority piece of the market share in almost every market they compete in. That provides an investor peace of mind, and the odds are strong that this company will be able to continue to boost earnings and dividends for many years to come. Do you ever see those old ads for 5-cent Coke bottles? They don't sell for that anymore. That's called pricing power. This is important as a dividend growth investor is looking for dividends that grow at a rate that exceeds inflation. Growing dividends come from growing earnings and cash flow. You can't increase earnings if you don't have pricing power. My strategy. I personally invest the majority of my net income into quality dividend growth stocks every single month. This is a form of cost averaging for me, as I do not believe in timing the market. Some months the market is down and some months it's up. I try to buy on dips within each month. I try to commit at least $1,200 to each transaction so as to limit the effect of broker fees. Thankfully nowadays, there are many brokers out there that you can purchase these stocks for free. They no longer charge you a commission to do so. I use Scottrade and they currently charge $7 per transaction. $7 per transaction. It's a good day to be an investor in today's world. I use income from my paycheck and combine it with dividends received from the prior month and use that combined capital to purchase shares in quality businesses. For instance, earlier this month I purchased 35 shares of Illinois Tool Works at $46.68 per share, 30 shares of Emerson Electric at $50.88 per share, and 50 shares of AT&T at $28.87 per share. My ultimate goal is to produce a passive stream of income from dividends that exceed my expenses, thereby rendering me financially independent. My expenses currently hover around the $1,100 mark per month. I expect my dividends to exceed my expenses before my 40th birthday. For beginners, I'd like to recommend building a core portfolio around large dividend growth businesses like Procter & Gamble, Coca-Cola, PepsiCo, McDonald's, Walmart, Johnson & Johnson, and similar companies. These are typically consumer-based stocks that aren't as hard hit when economic dips occur. Once you have your core portfolio built, you can branch out into companies in other sectors that still produce quality products and have a long-term track record of raising dividends and earnings at a rate that exceeds inflation. Companies like ExxonMobil, Intel, General Dynamics, Illinois Tool Works, Medtronic, and Visa come to mind here. In conclusion, I didn't want to get too detailed with numbers, ratios, balance sheets, cash flow statements, and the like. I wanted this to be a basic primer on dividend growth investing, and I want prospective investors to always remember the basics. When you're looking at stocks, you're looking at owning a piece of a company that produces something of value. If you don't personally see how that value translates to long-term growth, then it's probably a good idea to invest your money elsewhere. Thanks for reading Dividend Mantra. Update from Mr. Money Mustache. This fantastic guest posting ended up sparking a huge and somewhat unruly discussion in the comments. Again, if y'all want to see the comments on this particular blog post, the link to it's in the description box below. Experienced stock investors may enjoy reading through, while beginners might end up more confused than when they started. Writer J.L. Collins took the time to make a nice summary of the arguments with a clear summary here. And then he provides the link to that summary. If you're not familiar with J.L. Collins, he is the author of the book, The Simple Path to Wealth, which is a book I highly recommend for beginner investors. And I actually am planning on reading that summary for tomorrow's video. I didn't want this video to get too long. That article was a pretty decent length about dividend investing. You can either click on the link below and go look at that blog post, read all the comments, and go look at J.L. Collins's review of it if you want to right now, or just wait till tomorrow. I will read that blog posting for tomorrow's video. It'll be an extra bonus video this week. So, dividend investing. There are a lot of pros about dividend investing, and that is why I am interested in it, and I am trying to get a small dividend portfolio built up, as well as continuing to invest into my broad-based low-cost index funds. If you want to be an extremely passive investor, you don't really want to think about your investments too much, you don't want to do a whole lot of research or feel like you have to constantly check your portfolio all the time, then keeping it simple with index funds and ETFs is a great option. There's absolutely nothing wrong with that. However, some of the biggest advantages that I like about dividend investing is some of them they mentioned in the blog post. The biggest one for me is decreasing volatility in your portfolio in the event of a market downturn. say for example, you are just 100% invested in the market as a whole through, say, VTI, the ETF, through Vanguard, total stock market, VTI. I have some of that holding myself. But if that is your sole holding, you are 100% VTI. If the market as a whole takes a downturn, then you are going to see a huge downswing in your portfolio. And as an investor, you have to learn to be okay with that and not panic sell. So in my head, I feel like I would be okay with that because I know the market does go down. It will go back up eventually. And while in my head I feel like I would be okay with that, I haven't ever personally been through a market correction or a recession as an individual investor yet, so you don't really know what you're going to do until the time comes, right? So for that reason, I do want to get some dividend portfolio built up as well on the side to help a little bit with that volatility. Another thing I like about dividend investing is that these dividends are paid out based on the number of shares that you owe, not the value of the share price. So if you own 10 shares of Johnson & Johnson and the stock price of Johnson & Johnson dips down crazily for some reason, you still own 10 shares. Those shares may not be worth as much, but Johnson & Johnson is still going to pay you that dividend for owning those 10 shares. So when the market has a downturn, dividend investors are not as affected, as they mentioned in this blog post. And lastly, another good thing about dividend investing is that if you're building up a portfolio to live off of the dividends, then you never have to sell your shares of those companies to earn those dividends. In fact, the goal is to hang on to them as much as you can and buy more whenever a good deal presents itself. If you're purely index investing or investing in ETFs, and you get to the point where you're financially independent, you want to start living off your portfolio, well, you have to start selling your shares in order to get that income. So you just end up hoping that when you sell, the market's at a high so that you can get the most value for whatever portion of your portfolio you're selling off. If you happen to have to sell to get some income and the market's at a low point, then you're selling shares and you're not really getting a good price for them. Now, over the long run, everything averages out in the end, which is the argument that index investors have. But still, I like the thought of, with dividend investing, you're living off of the dividends. You don't ever sell the shares of those companies that you own. So to keep this video from getting super long, those are just some of the big reasons that I personally am interested in dividend investing. One of these days, I'm gonna make a video about my investing strategy. In fact, it's going to have to be several videos because if I just made one video about my investing strategy as a whole, it would probably be an hour or more just to explain everything to you. And also keep in mind, I am a beginner investor myself, so I'm still learning as I go. My investing strategy may change over time, but to keep the videos as small and concise as possible, I plan on making a series of videos about my investing strategy. And I'll show you my portfolio that I have through M1 Finance. I'll also talk about my retirement account that I have at work and what I'm investing in there, etc., and my reasoning behind choosing these investments. If you've made it all the way to the end of this video, thanks for watching all the way through. If you have not yet, don't forget to drop a like down below. Comment in the comment section down below what your favorite investing style is, and I'll catch y'all in the next video tomorrow. JL Collins's summary of all of the arguments for and against dividend investing. Thanks for watching, guys. Bye.